welcome to Finance Friday, guys. We're so happy to be back. This has been a while.
It's been a while.
It's been like 4 weeks.
Yeah.
This is the show, if you've never seen it before, where we transform your relationship with your money by giving you the information that you need to grow and protect your wealth. I'm Amy Novakovich. This is Ryan Wilson.
Hey, everyone.
Go to our website, novawealthmanagement.com. You can find all our previous podcasts, which we have a podcast and a wealth show. Oh, I forgot my phone to share it out. Go ahead and share it out right now. This is a big hot topic right now, so go ahead and share it out because even if it won't help you, it might help a friend. But go to our website, and our YouTube channel is on there, and it has all our previous Finance Friday shows on there, and we have a whole library of all kinds of good stuff. But 6 times this week, I had this question come up. Should I pay off my mortgage? So we're going to tackle it today. Because that's a lot. There's only 5 days
that's a
in a
lot.
week.
Yeah, that's
more
more than one in a
there's
day.
Only 7, but I mean in the work week. So in 5 days, I had 6 conversations around should you pay off your mortgage, which is insane.
Yeah, it's a lot.
That is a lot. So Ryan and I were talking before this, and there's not a whole lot of reasons that we came up with why you should pay off the mortgage.
Right.
There's one.
There's one good.
Don't say it.
Yeah, we're gonna save
We're
it.
gonna save it for the end.
Stay tuned.
So let's go over why you might not want to pay off your mortgage. I'm gonna kind of get the ball rolling on that. Should we go over the example, or you want to just talk about the overall concept?
Yeah, I mean, I think we can. I don't even know where
Try to break it down in like nice, simple terms, like without numbers yet, because I feel like numbers can get really confusing. Just the general concept.
So I'll just go with the first reason that you should not, on the top of my head, is that let's talk about that. There's other options. Okay. So another option might be that, I don't know if you've heard, but we're seeing that with the federal funds rate being lowered, mortgage rates may be lowered. And so maybe refinancing is a better option than paying off your mortgage with just writing a check and getting rid of it.
You can lock in a really low interest rate.
Yeah, so you could get a lower interest rate.
Lower your monthly payment.
Yep, and that means that your cash flow, as far as monthly payments, you're in the positive, or better off than you were in the past, and then you're obviously paying less interest. Another benefit of that, which may be a benefit, maybe not, depending, but as a cash flow standpoint, it could extend your mortgage again. Like you could refinance and get another 30-year mortgage, which then extends it, which makes your payment even lower.
Well, and some of you might be saying, why would I want to extend it?
Right.
You get to live in the house and enjoy the house, whether you have a 5-year loan, no year loan, it's paid off, or a 30-year loan. You're already enjoying the house, okay? So it's not like because you pay it off faster, you are enjoying more of the house. Like you already get the whole house.
Right.
The second thing is you already get the whole appreciation of the house. If your mortgage is, I don't know, $200,000 and your home is worth $300,000, whether your $200,000 balance is on a 7-year mortgage or a 30-year mortgage, either way, if you were to sell that property in 2 years, minus all the payments that obviously you pay down, I'm trying to keep it simple, you would still have the $100,000 capital gain. You'd still make the same amount of money. So I realize when you say, why would I want to prolong it? Because then I have more interest over time. But when interest rates are so low right now, we ran an example where if you actually invest the money instead, which most of you might say, oh, I just don't know if I want to invest. Well, that's a conversation that you need to have. But in our example, all you had to do was get a 2.5% return.
Which you don't have to be very aggressive in investing to be able to beat that. And so another reason why this might be a good idea
we'll go over the example
and again, this is more from a cash flow standpoint. If your goal is to pay less interest over the life of the loan, then extending it's probably not the best thing for you, because if you're going to extend and then go another 30 years, then you're going to be compounding with interest on that over time.
Unless you're going to invest it and beat what you pay in interest, though.
Right. But
if you're going to make more money than you pay, you're making money by using the bank's money.
Yeah. So
that's the simple concept.
If you're going to leverage that money, that loan, if you're going to leverage it and use the money that the bank is basically loaning you to make more money, then refinance, then it's a win-win. You're paying less ultimately over time because you're making money on that money, and you're lowering your monthly payment. So there's really no downside other than the fact that there are still closing costs and things like that you have to think about when you want to refinance.
So if you're going to sell the house next year, hey Johnny, if you're going to sell the house next year, probably not the best idea to go refinance and pay closing costs.
Right.
But if you have the ability to go out and get an equity line, equity lines, the rates just went down. Was it 2 days ago already, or was that yesterday that they lowered a quarter point?
2 days ago.
2 days ago. All my days blend together. But if they lowered interest rates, equity line interest rates went down, and there's no closing costs on an equity line. So instead of getting a traditional mortgage, hey guys, you could get an equity line. And yes, the interest rate is variable, but interest rates aren't going up anytime soon. And if you're considering selling the property in the next couple of years, you don't have to worry about interest rates going up on you to like 10%. Like that's not even a possibility. So you could go get an equity line, pay no closing costs, and get a super low. Like right now, there's some banks that are doing what they call prime. The prime interest rate, by the way, is like 3.25%. I should probably look that up. Or 3.5 -1, which means you get a 2.5 or a 2.25 interest rate on your loan. That's insane. So, I mean, I think anybody would argue that 2.5% to pay on an interest rate is super low. So let's go over the example real quick, because I want to kind of illustrate what we're saying. And we talk about the big concepts, but I want to illustrate in numbers what we're saying. Did you look up prime?
I can't find it. I'm trying to be too quick.
No, just say what is the current prime rate?
Oh, that's why I spelled it wrong. The prom rate.
That would help. Okay, so let's say, thank you for the thumbs up. Okay, so let's say that your original mortgage was $240,000. Your monthly payment would have been $1,216 a month at a 4.5% interest rate. Okay, you following me so far? Now, you've paid down over the years. Years and years and years have gone by. Your balance is now $80,000.
$475.
Is prime?
That's what it says. 2 days ago. Current prime rate.
2 days ago, 475. Oh, did I say 3.25? I was thinking 5.25. No, that's it. 400.75. So prime -1 would be 3.75. All right, that's still a great rate. Okay, so now if you have the mortgage balance is $80,000, and you've been paying all these months, and we calculated actually it was like a 30-year loan, and you would have 76 months left or 6 years left. Okay.
6.25 years.
6 years and 1 month, right? Something like
6 years and 4 months.
6 years and 4 months. That's right.
So 1.25.
So now, if you calculate how much in interest you would pay over the remaining life of the loan, your total would be your balance, $80,000, plus roughly $12,000 in interest, and bring you up to like 92 grand. So we did the calculation. We said, okay, how much would it take on $80,000 to make $12,000 over 6 years? The answer would be you have to average $2,000 a year on $80,000, which is 2.5% return.
Yeah. And sorry,
no, go
that's
ahead.
Also another reason why you wouldn't at that stage of your mortgage want to pay it off is because the way that mortgage loans are structured is that a lot of the interest is paid at the beginning. And so by the time you're at $80,000 left in your mortgage, like in this example, you only have, what did we say was the total?
The starting was $240,000.
Like what was the total, like the amount of interest that you'd pay from that last 76 months? Did we have that? It was like
the amount of interest that you paid, $12,000.
Yeah. So $12,000 over those last 6 years is a lot less than, I mean, if you over a 30-year mortgage is going to be like $100,000 or $100 and something thousand over that whole time. So the benefit at that point would be just to continue paying your mortgage payments because the amount of interest you're then paying is so low. Now, if you had a lot of money all of a sudden come to you like an inheritance and you had it at the beginning, it might make a little bit more sense because you have a lot, or maybe even just doubling your payment at that point because you have a lot of interest on that front end of the loan. Whereas
now you're just really paying principal.
Yeah. So depending on when you do this calculation, you might get a different number there, but we're looking kind of at the tail end where an $80,000, if you were to, pull it from a retirement account kind of thing, or if you were to get an inheritance, that's where we're kind of looking at that $80,000. If you were to come into $350,000 and you just did a mortgage, it might make sense to double some payments to get that interest over the period of the loan down a little bit. Does that make sense? I don't
Yeah, no, I mean, I'm following you. If
Yeah.
you're following him, give a thumbs up.
Yeah, or if not, then
Let us know.
yeah, comment and be
Comment
like,
and be
that
like,
makes no sense.
No, I have no idea. So the other reason that people will give is just like from a cash flow standpoint. So we're talking about interest, dollars over time that you pay versus dollars over time that you make on interest, not the cash flow of the actual principal and interest payment. So that's the other argument, is that they say, okay, well, I'm paying $1,200 a month. I'm paying, $14,000 roughly a year on $80,000. 14 grand is like 18%. So that's a big percentage cash flow wise, even though part of that is your principal though. So I would still make the argument that if you have the $80,000 invested, you pull principal and interest every month from that $80,000. Will it go down? Yes, but it's invested. Hopefully you'll have years where you're going to average 6%, even if it's invested moderately. So even if you pull on that $80,000 payment, deposit it to your bank, use that payment to pay your mortgage. At least the rest of the principal is still invested. Whereas if you put that same principal chunk in your house, yes, it's invested, but you were invested in the house anyways. You were going to get the appreciation of the house anyways. Just because you have paid off your loan doesn't mean in percentage you're going to gain more on the house. If your house value increased 10%, it's still going to increase 10%, whether you have a loan on it or not. The percentage is the same. Yeah,
and so, I mean, out of that 80,000, if you were to just pay it off, of that $14,000 a year that you'd be paying, I mean, maybe at that point of the loan, maybe $4,000 a year is going towards interest. So really, that's the only thing that you're wanting to really get rid of. I mean, as far as paying down a principal amount, that's yours.
You can still pull it from the $80,000 from the principal.
You still own that section of that portion of the house. So
right.
Yeah, I still don't think, you can make it make sense in your head. The idea of like, well, I have $14,000 more a year. Sure. But you could have been making more potentially if you were investing.
Well, and what I said to one of the people the other day, I said you could refinance that $80,000 mortgage, bring your payment down to like what, $800 a month, I think when we did.
Yeah.
$800 a month, kick it out over 30 years, especially if you're older. If you pass away in this house, like if you're going to stay in this house, what do you care if the kids net a little more or net a little less? Why not you enjoy the money while you're living, instead of you taking the money and pumping it into the house when you're already getting to enjoy and live in the house? If you have debt over 30 years and you die before the mortgage is done, the kids or the brother or the sister, whoever's left is going to sell that house. They just get the net proceeds. Let them deal with the debt, not you. You need to keep that money in your pocket while you're living to enjoy it while you're living. So now there is one reason that we came up with why you might want to pay off the mortgage. Again, I hope this is making sense because we're trying to talk big concepts with our $1 example, but there's many, many dollar examples. If you have any specific examples like my mortgage is this, my payment is this, send it to us, put it in the comments or even go to our website and contact us and email it to us privately and we'll help break down if it makes sense for you. But keep in mind that if you're under 59 and a half, you would have penalties on any retirement account money that you would pull out, plus income taxes. That's way more than any interest that you might owe. And that might be a year or two of cash flow right there in penalties. So that would be not good. But the one scenario that we came up with, just kidding.
I actually just thought of another.
Oh, you did?
Yeah. So.
Oh, I'm excited.
But yeah, you can. It's not a full payment, but it makes a little bit of sense. So you go first.
Okay. So if you have cash just sitting in a bank account and you don't want to invest it, like you're just not an investor or you have enough money in the market and you're over it, you just want the money to stay in the bank and you're earning like 1-2% in the bank. Yeah, your money is better off spent just getting rid of your mortgage payment because it's just sitting in the bank. It's not making you more money. It's not allowing you to make money off of the bank's money. You're just paying the bank more money by keeping the mortgage then, if you're only going to keep the money parked in the bank. So that's the one reason. If you've got all, I mean.
Yeah, and you have to have excess in the bank, because you don't want to then be cash poor. And then you're then going to have to take out a home equity loan if something happens anyway. So make sure.
Or go into debt.
Yeah. So, so make sure that if you're going to do that, that you're going to have plenty of extra. So if you have 80,000, make sure you have that 3 to 6 months of expenses in that left.
So I'm dying to know, what's this reason?
So the other reason I thought of is that if you had a loan that still had PMI. So if you had a private mortgage insurance on your loan and you had the cash to be able to pay that down, not necessarily all of it, but to get rid of that
That's
PMI.
a great reason. Yeah, because that's an extra payment. For those of you that might not know, private mortgage insurance is when if you don't put 20% down on a loan, that means you have to insure the bank, essentially. You have to put an extra payment on your mortgage that you'd pay above and beyond the regular mortgage. Yeah.
So especially looking from a cash flow standpoint, if you were able to, say you came into some money, if you had bought a house and then before you were 59 and a half, now you're old enough to take some out of your retirement to pay down, from a cash flow standpoint, it makes sense to get rid of that, because that's literally money you're throwing away.
Yeah.
And so the refinancing, you can now do refinancing where they even bunch the closing costs into your loans. You're not having to come up with that upfront cost. So there's a lot of ways to structure it, but I would say that if you have PMI and you have the money to be able to pay down and at least get rid of that
makes sense.
Then I would do it.
For sure. And then the last reason that we kind of said.
We said one.
Came up with three. Well, the last reason that we kind of said, although I'm not sure we ironed it quite out yet, but if you're trying to get approved for another loan, let's say on an investment property or even sometimes a car or a boat or whatever, and they are requiring you to have a lower payment to income ratio, like maybe you're a business owner and you're not showing a lot of income, and they're requiring you to have a much lower debt payments all added together, all of your debt payments added together, and they want you to lower it. I guess that would be another reason to pay it off, because if you pay it down, unless you refinance, your payments won't change. So you'd have to pay it off in that scenario to then get approved for the loan. Yeah,
and that's more or less kind of a roundabout way of refinancing. You're basically taking that portion, you're paying that down to then get a lower interest rate on the other side. So but I think that makes sense, is that if you're able to get a lower interest rate and then you move, kind of get a new property, whether it's investment property or whatever, then that would make sense.
So at a high level, let's try and summarize the 17-minute conversation that we have. Okay, so why would you not pay off your mortgage? First of all, it might make more sense to refinance and just lower the payment, because right now, if you can get a super low interest rate, whether it be on an equity line or a brand new mortgage, if you're actually going to stay in the house, it makes sense, because the interest that you will make on money invested over time could be more than interest that you will pay. So you're making money off of the bank's money. Also, if you're going to stay in the house until you die and you're older, why pay off the mortgage and take that money out of your pocket to enjoy while you're living? If you're going to stay in the house, you get to live in the house no matter what. So let the kids or whoever inherits the house deal with, when they sell the house, they get, whatever's net and left over, and keep that money in your pocket. And then really, again, at a high level, when we talked about paying off the mortgage overall versus not paying off the mortgage, if you are towards the end of your mortgage anyways, you're really just paying on principal. You already paid a lot of the interest.
You did the work.
So you did the work. So honestly, at this point, it just makes more sense to keep the money, if it's invested, in a place where it can earn 6 to 8% average annually. I mean, it just makes good sense to use that money, because you're living in the house anyways. When you sell the house, you get the same amount of appreciation. Percentage wise, the house doesn't appreciate more. Dollars wise, yes, you get more dollars back in your pocket, but it's just your own money. You would have still, if you take the amount that you have sitting there plus the appreciation, that's the same dollar value than if you pay off the house and take all the appreciation. Are you following me? Did you follow me? Add the two pieces together versus just having all the appreciation, because you get more out of the house when you sell it if it's paid off.
Right.
It's the same dollar. So really the question is, investment wise. What am I making on the money and what am I paying on the money? It's that simple. It's more about making smart financial choices to make more money and pay the big boys less.
Yeah.
Right?
Pay them less.
So again, if you have a specific situation and you're wondering, should I pay off my mortgage? Go to our website, contact us through the website. It'll email us, give us all the specifics. We need the balance, the terms, the original mortgage, the interest rate, and then where the cash would be coming from, either a bank account or investment account. And we can help you and try to play the game of, should you pay off your mortgage?
Yeah, and I'm sure there's, if you break the break even of that, I mean, I'm sure there's a ton of examples where we could say it might be.
We could put it in the financial planning software or an
Yeah.
Excel spreadsheet and show which one makes more sense.
It's so we'd love to do it.
Yeah, absolutely. Give us the challenge. All right, guys, have an awesome weekend and see you next week.
Yeah. See.
We'll try.
Have a good weekend, everyone.